Welcome to BT Podcasts. In this episode, find out what the benefits of discretionary portfolio management are and why you should consider it. This episode is brought to you by Barclays Private Bank.
Discretionary portfolio management offerings are increasingly popular in Hong Kong and Singapore as clients become familiar with various mandates and their benefits. Let's figure out why and how we can get in on the action. Welcome to Podcast by the Business Times. I'm Howie Lim. In this episode, we get insights from Ong Shun Wei, Head of Discretionary Portfolio Management or DPM Singapore at Barclays. This episode is brought to you by Barclays Private Bank. Shun Wei, thanks for your time.
Thank you for having me, Howie.
Even though I know it's discretionary portfolio management, we bit of a mouthful. Maybe you could explain to us what exactly DPM is.
Yes, absolutely. So DPM stands for Discretionary Portfolio Management, as you have correctly pointed out. And it is a way of investing when a team of seasoned portfolio managers invests on a client's behalf. So imagine you are a client of Barclays Private Bank who has a DPM mandate. We will construct a portfolio for you based on the investment strategy you have chosen, given your financial goals, risk tolerance, and investment horizon. We make the buy and sell decisions within the portfolio at our discretion, and that is how the name has come about. Whether it is our multi-asset portfolio with an almost 20-year track record, our popular global equity strategy, or a bespoke fixed income mandate with a blend of both developed and emerging market bonds. At Barclays Private Bank, we have a strong DPM DNA, which allows us to manage more than $25 billion of DPM assets. My role as head of DPM Singapore is to launch the DPM team here and to bring our strong global DPM strategies to Singapore as well as the region, while expanding the firm's investment capabilities in Asia and in emerging markets. So truly a very exciting time for us.
So you talk about how you do take into account an investor's risk tolerance. So say the very risk averse. Talk to me about the benefits of DPM then.
There are quite a few. Well, first and foremost, when you have a DPM mandate, the portfolio will be professionally managed. At Barclays, we have a highly experienced, stable, and long-tenured team of portfolio managers with expert knowledge of financial markets, investment strategies, asset allocation, and what is also very important, risk management. We spend a lot of time and resources managing risks because to us, investing and risk management must go hand in hand, and our strong track record proves that this philosophy works. Second, by having a DPM portfolio, you are able to avoid falling into the trap of investor biases and emotions. Very common when you trade in and out of the market yourself. At Barclays DPM, we have a clear investment philosophy and process, which we apply and abide by in a disciplined manner through market cycles. Third, investors are constantly trying to time the market, which is extremely hard to do. With DPM, you can avoid this. Our portfolio managers do not concentrate on timing the market, but rather we focus on building a high-quality, diversified portfolio that can withstand the test of time. As the saying goes, time in the market is better than timing the market.
Who would need a DPM though? Let's say accredited investors. They know what they're doing. They've been doing it a long time. Why would they, for example, need a DPM? Or who exactly should have a DPM, Shun Wei?
Sure. The first obvious reason would be that if we manage your portfolio for you, you will have more time to focus on other things, whether it is your work, time with family, or time for your hobbies. And you can feel safe in the knowledge that your portfolio is being managed professionally and expertly. On the question on who would benefit from DPM, I would say anyone, but all the more so if you have a substantial amount of wealth. So whether you are a working professional, business owner, retiree, or someone who has inherited wealth. Even if you like to buy and sell stocks on your own, you should still allocate the core portion of your wealth to a DPM portfolio for the reasons that I've shared. So let us invest for you for the long term and set aside some cash for your own trading. That can certainly work. Now, Barclays DPM is a high conviction portfolio manager, meaning your portfolio will reflect the team's best ideas. This is what we do. Constantly looking for high-quality companies and investment opportunities as well as building and managing a well-diversified portfolio across countries, sectors, market drivers, and asset classes. So clients will benefit by leveraging on our resources, be it personnel, infrastructure, or the global reach of Barclays as a firm to navigate the complexities of markets and add value to their portfolio.
Let's say you're thinking about it, want to shop around for a DPM, right, Shun Wei? What sort of factors should you look out for?
First of all, you have to assess that the investment strategy proposed to you is suitable for you. Second, take time to understand what the DPM team's investment philosophy is, how they do things, and what their investing DNA is. Have a look at their track records and the makeup of the DPM team. At Barclays, the track records of our flagship strategies are long, 10, 15, almost 20 years. More critically, the strong performance numbers you see can be backed up by portfolio managers who are still with the team. Our average tenure of portfolio managers is 10 years, quite long and rare in today's industry. Finally, assess whether the DPM team is one you can truly partner with effectively and for the long term. Is client servicing at the top of their minds? And to Barclays, DPM is a people's business, and we are constantly thinking about how to be great partners of our clients. We do not only need to deliver on investment performance, which is of course very important, but also have to work together with our bankers as one team to provide top-notch service to the DPM client. This is how clients will choose us, because they can trust us to deliver and be there for them in both good times and bad.
Still to come, if you're one who would rather invest yourself and give up control around investing, should you still consider DPM, Discretionary Portfolio Management? More with Ong Shun Wei, Head of Discretionary Portfolio Management, Singapore at Barclays. Stay with us.
And now back to BT Podcasts, brought to you by Barclays Private Bank.
We're speaking to Ong Shun Wei, Head of Discretionary Portfolio Management, Singapore at Barclays. Shun Wei, let's talk about if there is like an ideal situation, the best kind of financial market, so to speak, that DPMs prefer.
Well, Barclays DPM seeks to add value in both strong and weak market environments. So whether markets are calm or volatile like what we have seen over the past couple of weeks. And we do so by having a robust and disciplined investment process in place. Our stringent analysis process means that we are crystal clear about the value that we hold in our clients' diversified portfolio and the associated risks, both at the portfolio level and on more granular levels. This way, we are able to invest with a long-term view and invest like business owners. We may, of course, react to short-term volatility by trimming risk exposures or buying on dips tactically, all with the ultimate aim of generating strong, risk-adjusted long-term returns for our clients.
You know, there's this narrative surrounding DPMs, right? And then you mentioned it earlier too. You really should only consider getting a DPM if you have a certain amount of wealth. So then there's that idea, one man's substantial is another man's not so substantial, if you will. So how are you going to change that narrative? Because also, what if I just want to invest it myself? I know what I'm doing. I'm an accredited investor. I mean, why should I give up that kind of control, right?
That is a very good question, Howie. I must admit that clients here in Asia have caught on the concept of DPM later than those in Europe, but better late than never, right? Now, in recent years, we have seen an increase in interest, particularly from ultra-high net worth individuals and family offices. This has come at a time when we are seeing generational wealth transfers and strong accumulation of wealth in the region. There's also a greater awareness on the advantages of having their assets managed professionally in DPM and in an institutional way. So how do we continue to steer this narrative? I believe client engagement is key. Like I've mentioned, DPM is a people's business where we work hard to earn the trust of our clients. We differentiate ourselves here in Barclays by combining the excellence of institutional asset management with the high touch of a private bank. Our clients enjoy access to portfolio managers for updates on their portfolios, and I know from my years in this business that trust can even be earned during bad markets or periods of underperformance, when clients see that you are constantly available to them and able to justify your investment decisions, explain your outlook and positioning. And this is what this newly set up Barclays DPM Singapore team seeks to do, expanding the investment capability of an already highly successful global DPM team by bringing new investment expertise in emerging markets and Asia to the team for our clients here in the region. Ensuring that we have on-the-ground portfolio managers here in Singapore and the region to provide a high level of client servicing, and doing our best to gain our clients' trust and working hard to continue changing this narrative around DPM.
Last question, Shun Wei. When do you sleep?
Almost never.
That's a criteria I think one should look for. Shun Wei, thank you so much for your time and insights.
Thank you, Howie. Thank you for having me.
I'm Howie Lim. This has been BT Podcast from the Business Times.
This episode of BT Podcasts was brought to you by Barclays Private Bank. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.